Good morning or good afternoon, everyone, and thank you so much for joining us in today's webinar. Well, you'll learn all about DSCR loans. Now, as questions come up throughout the webinar, please go ahead and submit your questions using the little questions tab. At the end of the webinar, we are going to be doing an extensive question and answer session so that you can get answers you're looking for. With that, I'm going to turn it over to today's speaker, Jamie Gelso. Take it away, Jamie.
Thank you, Rose, and thank you for everyone for attending today. My name is Jamie Gilso, and I'm joined today by Tim Turley. Uh, we help close some loans in the Eastern U.S. every month, and glad to talk about some of those things today with you. Just a quick agenda. We'll touch briefly on Lensure and why we're a very viable partner for you. Talk briefly about the investment property landscape. Go over some of the basics of the DSCR loan, some specifics, give you some insight on maybe finding some of this business and helping you prospect for it and giving you some resources to do so. A little bit about Lensure Mortgage Corp. We were founded in 2015. We're headquartered in San Diego, California. We have two regional operation centers in the Eastern US to support those time zones, one in Rhode Island, one in Georgia. Very experienced non-QM management team with decades of experience each. And we currently lend in 42 states, and we're always growing. Why would you want to partner with Lensure? Here's some reasons. We operate with flexibility. We base a lot of our decisions on compensating factors and really common sense underwriting. Somewhere between 40 to 50% of the business we do each month is an exception to our guidelines, but the loan made sense for a lot of reasons, so we opted to fund it. We have a team of experienced AEs to help you assist structuring your files and providing some of the best pricing options. We have an upfront pre-qual process that helps vet the file up before it goes to underwriting. We understand that many people don't have experience in the non-QM space. As a result, you'd probably like a little more reassurance, especially if you're dealing in the purchase market and you've got realtors that rely on you. So we will vet your file up front. We will calculate income on files prior to underwriting if needed, things of that nature, so you can proceed forward with confidence. Each of our regional sales teams is supported by their own operations teams, their own underwriter, their own account managers. The AEs are assigned one-on-one basis with account managers. This helps create good relationships, streamline the process. Your processors get to know our account managers, and they tend to work pretty seamlessly together. We encourage communication between our brokers and our upfront pre-qual underwriters, our credit analysts, as we call them. Again, we want to structure the deal up front the best we can. We want to identify any issues. If there are exceptions, but the deal makes sense, that's fine. Let's not hide from them. Let's address them, and let's get them signed accordingly. So a little bit about the investment property landscape, and that's what we're talking about today specifically. There are over 43 million investment properties in the United States today. We also know there's a bit of a building boom going on. Many borrowers or owners of investment properties utilize hard money loans. They do this for a couple of reasons. Quick turn times. Often they can't qualify elsewhere, quite frankly. But as we know, hard money loans come with higher points and fees and are generally shorter term balloon notes that get called. Also, property investors, and we're talking to professional folks, typically have multiple properties. They're continually looking to add good cash flowing properties to their portfolio. On the other hand, they may be also refining hard money after a purchase or a fix and hold type of scenario. And all that basically results in what could be good business for years to come from the same borrower. And we see a lot of that today, honestly. You see a little stat here that shows the multifamily market was on a pretty good trend for the last 10 years. COVID obviously messed up a lot of things last year, but so far this year, that trend is back up. Interestingly enough, again, we want to try to help you look for some business. Some of the best areas that we've seen for the multifamily market are some of the markets that you wouldn't think as flashy or exciting. People always think of Orange County or Florida or New York or Boston, which are great markets for great business. But some of the heavier DSCR coverage and multifamily areas we see growth in are places like Cleveland and Cincinnati and Detroit. Makes sense when you think about it. Those folks are renters in many of those areas. There's a basic way, many of you probably know this, but there's a basic way to figure out your debt service coverage ratio, or what we call the DSCR. In essence, you're taking your gross rents and dividing those by your PITA, or PITIA, pardon me. We throw the A in for condos. You have association dues in there sometimes, clearly, that can affect things. And you are looking for that, basically one to cover the other. You're looking for at least a 1% coverage ratio. Simple numbers, if your gross rents were $3,000 a month and your PITIA was $3,000 a month, you would have a 1% DSCR coverage ratio, which is sufficient for most programs. Less than 1% means that technically the property does not cash flow. At Lensure, we do allow for programs below 1% on a purchase basis and above 1% for all programs. So basically your property needs to cash flow, and that's how you figure that. You'll either have leases, or if it's a purchase, we'll go off of the appraisal. Here's an example if you've never seen an investment property grid on appraisal. Basically, you see your subject property rents along with your comparables. We can use a number higher than this appraiser shows, but you would just need to show proof of that to us that it's viable. So a lease, maybe most recent month's proof of payment based on that lease amount, and we can use an amount higher than the 1007 would show. Part of the reason people like the DSCR program is the ease of use. Again, this whole income calc is based on the cash flow of the property, so there's no other income docs required. There are no W-2s, 1099s, 1040s. You may need leases, that would be the extent of it. Need a completed schedule of real estate owned, meaning for properties that are not on credit, you would not need mortgage ratings, and you would not need to verify taxes and insurance. Now, what we ask for in these situations is just a good schedule of real estate from the borrower. Again, many of these folks are professional. They already have these prepared right on their desktop. Property address, date acquired, value, amount owed, gross rents, taxes and insurance. So we do ask for that. We want to know it, but we're not asking for the documentation to prove it. If there are other mortgage ratings on the bureau that are not paid as agreed, we will not ignore them. So, if somebody's got a foreclosure on there and it's a non-subject property lien, we will take that into consideration. But we're not going to ask for documentation on other things. We can close multiple loans for the same investor at the same time. I think we closed 4 for somebody yesterday, honestly. So these, this equates to fast closings because of minimal conditions. Some of the bullet points in terms of guidelines: we will go up to 80% LTV for a purchase on this product, 75% for rate and term of cash out refi. Loan amounts up to $1 million. Cash out up to $500,000. No limit on the number of properties owned by the borrower. We can finance up to 10 properties for one investor. Non-warrantable condos allowed. That's great, especially in some of the bigger cities. We can qualify the payment in the DSCR coverage ratio based on the interest-only payment. So, unlike your traditional that most of you deal with every day, owner-occupied purchases, if you were to do interest-only, you'd have to go with the fully amortized payment. On DSCR investor loans, that is not the case. If you've dealt with property investors, you know that they love cash flow. That's their livelihood. So if you can offer them a lower payment, that would probably make them pretty happy, and would also may help you qualify for the loan, depending on how tight the coverage ratio is. Why this product works well against your traditional Fannie loans for investors: Clearly, Fannie maxes number of properties owned. We don't. Minimum FICO is clearly different. Yes, we allow non-multiple condos. Yes, we allow LLCs. That's another sticking point. As you probably are aware, many of these investors keep these properties in LLCs for a variety of reasons, tax and liability consequences. We do allow that. And of course, Fannie does not have a program that just uses income off the subject property like this does. Another advantage we have is the ability at Lensure. It's kind of unique to the industry. We can finance in points to buy the rate down. And again, if you think of your average property investor, cash flow means everything to them. So here we've got a basic example. And by the way, this is a rate that would have some hits or adders or LLPAs, if you will. It's a cash out refi on a 4-unit investment property, right? So you go into your average rate sheet, you'd see some pluses on the rate side. 400 grand loan, 70 LTV. Our base rate was 5.375, which I think is pretty strong. If we charge 2 points, we can buy the rate down by 1%. Our net rate is 4.375. Those 2 points are financed in. So our loan amount's 408. Pricing stays at 70. And if you look at that, I mean, again, this is a cash out refi, 4-unit investment property with no income documentation. Income is based solely off of the cash flow of the subject property. I think that's a pretty good rate for that kind of credit complexion. I'm going to go over a couple quick scenarios and I'm trying to give you something, a couple different ones, not just your vanilla, off the matrix stuff. So here we had a professional property investor that wants to buy a new property for $1.2 million. Wants to put $300,000 down, so LTV looks pretty good. The problem is no matter what you do, the DTI won't work based on some parameters or factors that I won't go into here. The debt service coverage ratio wouldn't work, but clearly this person wanted to buy this property. Bank statements wouldn't work, 1040s wouldn't work. So what we did is we noticed he has 9 investment properties free and clear. They're all worth, I don't know, around $200,000 each. We gave him a cash out loan on each of those 9 properties for $100,000, totaling $900,000 total proceeds. Added to his $300,000 he already had, he buys his new property for $1.2 million cash. That's a great example where your account executive, in this case, the account executive took a look at this deal, saw that the original structure or request could not be granted, but saw a solution based on this DSCR program. And so the loan officer is very happy because they can go back to the borrower and say, we did it for you. It's a done deal. And with this profile of investor, again, he's going to have more business to give. And I got to believe this loan officer will get a fair crack at it because of these results. Scenario B, this is a common sense exception. It's not a small exception. Father and son want to buy an investment property in the Hamptons. Beautiful property, new construction, 0-edge pool, all the bells and whistles. Price is $2.9 million. The ask is for 75 LTV. It's a pretty big loan amount. If you remember earlier, our maximum loan amount of this program is $1 million. So that's more than double program max. Not to mention 75 LTV on that size loan is probably a little bit rich in LTV from what you might normally see on any program. But we had a couple of seasoned investors here. These were mature professional gentlemen. Both had credit scores in the 800s, very, very deep credit. Post-close assets verified of $12 million, not including their REO, which was impressive, but this was $12 million in, Morgan Stanley type accounts. So we made this loan. Again, I could tell you that the realtor and loan officer were very, very happy. This is a great example of a common sense, make sense exception. If you've been in the mortgage business for a bit, you might have been trained, would you lend your money on it? I think based on what we see in terms of the assets and credit scores in this file, most of us would have. So we're glad to do the loan. I'm going to flip it over to Rose now. She's going to give you a little insight on how to look for some of these borrowers and maybe some of the tools that we can provide to help with those efforts. Thanks, Rose.
Great. Thank you, Jamie. So here's a quick and easy exercise that you can do right after this webinar is finished. And it's a great way to find property investors in your area. Go to Facebook. In the search tool within Facebook, type in either your city, your state, your metro area, and then the words property investors in the search. In the search results, you're going to get a ton of different search results. On the left hand side over here, you can see you can click on groups, and that will filter it to show you all of the groups. Here's an example of one that I did, San Diego property investors. And you can see there's a ton of different investment property clubs. So these are groups that they talk to each other, they refer business to each other, and they're actively looking for solutions. So that is a fantastic way to get yourself connected, not only to meet people, but also to learn what are their issues, what are their problems, and what you can solve for. Other ways to find property investors, the National REIA org. If you go to this website, there's more than 100 of these association groups in the country, and so it's pretty easy to find one near you. Go to this website, and then you can just click on find an REIA near you, and that's going to connect you with the local association. Maybe contact them saying, hey, I'd like to be invited to your next event, or maybe I'd like to give a presentation, or I'd like to give educational resources to your membership. So that's a fantastic way to connect with property investors. Another way is through meetups. If you've never been there, go to meetup.com. Meetup.com has networking events from everything from scrapbooking to salsa dancing to investment property to realtor events. So go there and search real estate meetup on the homepage, and you can find events in your area. Again, these are sometimes they're just networking events. Um, Sometimes they're happy hours, but they're ways for you to get face to face and start shaking hands when the COVID emergency is over with real estate investors and even realtors who can refer their real estate investors to you. Another one of these sites is Eventbrite. Just like meetup.com, this is a very popular way to find local events. You can even One way you can do is partner with our one of your account executives here at Lensure. They will go with you to give presentations and answer questions on DSCR as well as the other investment property financing options that are available to them. You get to meet them face by face, and they will be grateful for the opportunity. And sorry about that. So, private label resources, these are things that I put together for you. And there's flyers, there's postcards, there's banners, there's even Outlook email templates. It's very easy to put in your information at the bottom. You can put in your logo, you can put in your disclaimer so that you can start marketing to these people right away. You can use these resources, you partner with our account executives, and you search for the local resources in your areas, and you can start generating more of this business within 30 days. And sorry, with that, I'll turn it back over to Jamie.
Thanks, Rose. Um, Again, one of the reasons we're having this webinar is to not only help you understand DSCR loans, but to help you find this business and to partner with you to find this business. We're very much a relationship-based firm. So we'd be glad to, any one of our account executives, be glad to get on the phone with you for 20 minutes and talk through some of these particulars of this product and how it might relate to your market. We do business in, again, 42 states, most of the country. Many markets have their own nuances, idiosyncrasies. We had a deal come in today in the Northeast where there's 2 properties on 1 deed. It's actually common in some areas. So, we'd love to sit down and just go through some things with you and help put together a plan and give you some marketing resources to find some more business. So to pull it full circle and wrap it up, we'll open it to Q&A. Again, we do want to build a partnership with you. We can help you research and identify some of these groups in your market. We have AEs that obviously, based on some of the examples we've shown, can help you structure loans in scenarios. help you learn the DSCR product. I think we touched on some of that. And close multiple loans. And again, we saw one example where one borrower, 9 loans. So with that, again, we do have Tim Turley on the phone. Tim oversees all of operations and underwriting for the Eastern U.S., sees plenty of these loans daily, and we can open up the Q&A from there. Thank you for your time.
Thanks, everyone. So as I mentioned earlier, please go ahead and use the questions tab, and we will get to um, as many of your questions as we can today. I know a lot of you are asking about, I know that we covered a ton of information here, and a lot of you are asking for a recording of the webinar and a copy of the slides. Not to worry, in about an hour or so after the webinar, you should be getting an email, a thank you email from me, Rose Waldy, that says, that has a link to the recording of the webinar, and it'll have a link to the private label resources, and it will have a link to the slide deck. And if you have any questions, go ahead about any of this, go ahead and reach out to your Lensure account executive. If you don't have a Lensure account executive or you don't know who it is, feel free to reach out to me personally. Just reply to the email, it'll come to me, and I will connect you with the proper person. So with that, Jamie, how many properties can you finance? What kind of properties can you finance?
Jamie, I'll jump in here because you sales guys typically want to say we finance as many as you want and any type of property you
I was
want.
just going to say yes. I was going to say yes, Tim.
But truth be told, we'll do up to 10 properties for one individual, and there is no limit on the number of properties they can own. And we do 1 to 4 units, and we also will do warrantable and non-warrantable condos. So there's virtually every property other than a multi-unit that's 5 units or more that we will handle under this program.
Okay. Can we do a cash out refi investment property vested in an LLC?
And Jamie would say yes, and he would be correct. We will do a cash out refi in an LLC.
Okay, great. And the foreign national loan options for DSCR, do we have any?
Yes, we will allow a foreign national to do a DSCR. We limit the LTV to 65%. But as Jamie said earlier, if for the right loan and the right borrower, we make exceptions on over 50% of our loans to our standard guidelines.
Okay. In California specifically, the Bay Area, properties rarely cash flow, and even a 0.75 on a purchase may not meet the cash flow requirement. What are the options for negative cash flow properties?
Currently, we will only go down to the 0.75. For the right borrower, we may make a slight exception for that, but that would be a tough one for us.
What about other investment property or other options for investment properties?
We
Would
have
that?
our
Mhm.
Yeah, we do investment properties under our expanded program where a borrower can own an investment property. They would just have to qualify on their income versus the cash flow of the property.
Oh, fantastic. In Florida, condo-tels are common. How do you handle these?
We do condotels. We have condotels available on our expanded program, and we have recently done a condotel under the DSCR program. We do them on a case-by-case basis, but if for the right borrower and the right property, we will consider that.
Can we do mixed-use properties?
That's very similar to the condotel. We will do a mixed-use property as long as it's common for the area and that it's not a unique property. We've done several of them over the past year, and again, they're going to be looked at on a case-by-case basis.
Okay, and sorry, I'm just searching through all of these. And you answered the question about foreign national DSCR already. Can you do more than 4 units?
No, currently we are limited to 4 units. We do 1 to 4 units. We do, as we mentioned earlier, condotels, warrantable and non-warrantable condos.
I'm not sure what this question means, but I'll ask it. How do you handle a subject to appraisal when the home doesn't meet MPS?
So if we have a subject to appraisal, it depends on whether it's a health and safety issue as to whether or not we will require the improvements to be done prior to closing. On a non-health and safety issue, we may go with an as-is value, or we can, in some cases, escrow for the repairs. If it is a health and safety issue, many times we'll want those corrected prior to closing. It would be looked at on a case-by-case basis based on the individual property.
Okay. Relating to the scenario A that we did earlier, and I guess in general as well, what are the typical closing costs for these loans?
That would depend on you as the loan officer as to what you negotiated with your borrower. Our standard closing costs are going to include an appraisal, title work, credit report fee, and then whatever either lender paid or broker paid closing costs that you've negotiated with your borrower.
Okay.
Yeah, our standard fee, Rose, for a loan is $12.95 on full doc and $15.95 on bank statement, in addition to the fees that Tim mentioned the broker would charge.
Okay. Is this a 30-year fixed loan?
We offer both fixed and ARMs. Currently, our fixed rates are very attractive. So I would say yes, but we also have a 5-year and a 10-year interest only available, depending on what your borrower's interest are. I know the interest only, because on the DSCR program we will qualify them on the interest only payment. It's very attractive to investors.
Okay. Another question about scenario A, when we did all those loans together, does each loan have a set of closing costs?
Yes.
Okay. Um, Sorry, one second. And for properties where you want to do repairs on the property, such as adding a pool, etc., how do we work that into the loan?
That goes back to what I said earlier. It would depend on what the issue is. If it's a property that is a health and safety issue, we may want those repairs done up front, or we would want to escrow for those repairs. If it's just a property improvement loan, we would typically escrow for those repairs and base our value on the current value. We typically do not base our loans on a future value.
Okay. Here's an interesting one. Do you allow Airbnbs?
Yes, we do. As long as we can show a history of the income, we'll look at whether it be Airbnb or just a regular monthly rental, or somebody's going through VRBO or something like that. We've done multiple loans where borrowers have used those services to rent their properties, and we'll look to get an average rent. Typically, when we do a DSCR loan, we're going to look for the appraiser to tell us what the average rent's for the property. But if the borrower can prove that they're earning more rents by going through VRBO, and we can get documentation of that, we'll go with the higher rent amount.
Okay. Is there a prepayment penalty?
Yes. On a DSCR loan, we typically have a 3-year prepay. It can be bought down to 12 months for basically a quarter for each year. But we do have a prepay.
Okay. Uh, is there a 30-day close or 46 to 60 days?
Jamie, correct me if I'm wrong, but I don't know of any loan that, other than a new construction, that's taking us greater than 45 days to close currently. But yes, I would say there is absolutely an option for closing within 30 days if you have a full package, actually less than that.
Okay. I'm getting a lot of questions about who my account executive is, etc. So if you have a question about who your account executive is, go ahead and just reply to me in the thank you email, and I will connect you with your Lensure account executives. Do you do blanket loans for more than one property in one loan?
No, we do not. We will allow a borrower to do up to 10 loans on 10 different properties. And we actually had a scenario come up today where the borrower had blanket insurance policy on all of the properties, and we allowed that as well. So we allowed them to insure all the properties under one policy, but we closed 10 separate loans.
Okay, here's a tricky one. How do you handle borrowers that may contact you directly after closing to fund their loan for future business?
We are a wholesale lender, so we would typically refer them back to their originating broker.
Fantastic. And I've a couple of other questions. I think do we have let's see, do we do any business in San Francisco Bay Area?
A ton.
Will you are properties on leased land eligible?
Case by case. There's certain requirements with leased land. The land lease has to outrun the term of the loan. It needs to be comps. It needs to be, common for the area. So those would be one of those ones like Tim mentioned in terms of mixed use. It'd be case by case.
Okay.
Yeah, but if it is common for the area, I know I personally am in Georgia, and there are several lakes in Georgia, which the property around the lakes are owned by Corps of Engineers, and as long as they can comp it out to common properties, and the lease, as Jamie said, outruns the terminal loan, we would consider that.
Okay. The DSCR rate is higher than Fannie/Freddie. If borrower already has 10 financed properties and finance 11 plus properties with Lensure, can the borrower refi existing properties using Fannie/Freddie guidelines, which has a lower rate?
I think I think what you're asking, or what that person may be asking, is if the borrower currently has 10 loans with Fannie or Freddie, which of course has lower rates, and if they then perhaps refied some of those loans to us, could they then, because they now have less than 10 loans with Fannie and Freddie, refi a new loan or a new purchase? I wouldn't want to speak to that, but I'm not sure I'm fully understanding the question.
Yeah, I would add on to that they can have up to 10 loans with us, and there's no limit to the number of properties that they own.
Okay, great. And I'm getting a few questions that are very specific scenarios. So what I'm going to do is go ahead and ask me those questions after the webinar and reply to that, because I want to make sure that you get the most accurate information possible. So I don't want to give you a general information to a very specific question. So go ahead and reply to my email and I will connect you with that. Do we need credentials for the website to get the marketing materials? I'll take care of that one. No, you do not. Go ahead and click on the link. I'll send you the link after the webinar, and you can go ahead and download some materials. There are additional materials that are available that you can get through your account executive, and those are the presentations that you can give to your property investors and realtors. These are designed specifically for them, so it's not going to have a ton of jargon on it. It's going to give them just here's some options for your investment properties. And in addition to DSCR, it also includes the other types of documentation so that they can see the wide range of options available to them. So for those, connect with your Lensure account executives. Otherwise, you can go ahead and click on the link that's going to be in the email that's coming. So that is that. And I think that is about it for
Hey, Rose, I wanted to touch on one more thing. Earlier on, one of the questions was about properties that may not hit the DSCR coverage ratio of 0.75, and what other types of qualifications could we use? We do a lot of bank statement loans, so in some cases that may work. But we have a unique way of using the way we add a negative rental Tim, you want to talk about the net rental method at all? How we're different than Fannie and Freddie on that, or I can, but.
Yeah, I'd be happy to, Jamie. We are different in the way we calculate income when it comes to negative net rent. So if a borrower is losing, say, $500 on a rental property, in the Fannie Mae world, they're gonna include that as a liability. They're gonna say they got a $500 debt. In our world, we're gonna subtract that $500 from the income. And by doing that, you usually gain 1 to 3% in debt ratio. So that's another very powerful tool that we have as a way to overcome a property or a borrower that may not qualify under Fannie.
Sure. So, and again, every deal is different, but on those deals where for whatever reason, maybe your debt service coverage ratio is a bit below 0.75 based on the rest of the transaction, the rest of the borrower, maybe if we employed some other methods, we could make it work. So.
Okay. And the last
I will say that
okay.
the biggest thing that is a common theme throughout Lensure is we are looking for ways to make loans and make loans that make sense. So if you've got a loan that you're struggling trying to figure out, don't hesitate to reach out to us and let us work with you to come up with a plan to make these people a loan. We want to make good loans to people that are going to pay us back, and everybody doesn't always fit in the Fannie Mae box. We've learned that, and our loans perform well, and we're proud of that. So I would say it's a very, very unique world that we live in when we can take a borrower, especially self-employed borrowers, and work with their debt ratios to make them fit into our box versus Fannie Mae box, as Jamie said.
Okay. For foreign national borrowers, can they use gift funds from U.S.-based family members?
We will allow that again on a case-by-case basis. I just did it last week. It's not a lot of the things we do aren't necessarily written in our guidelines. If it makes sense, if we're going to lend to a borrower at 85%, and now he needs gift funds and he can get a 10% gift, and we make that loan at 80%, we're going to do that. I mean, that makes sense to us. So I would say that don't let the box keep you from coming to us. We're always going to look at what makes sense from a lending standpoint.
Okay, great. All right, everyone. With that, I want to thank everybody for joining us today. Jamie, do you have any parting words?
No, same thing. I'd like to thank everybody for their time. You can reach out to any of us, our AEs, operations managers, ourselves. We're on the phone daily with brokers, helping them structure loans and build their pipelines and build their referral base with realtors. So be glad to help any way we can. Thank you, everyone.
Tim, any parting words?
I would just ditto what Jamie said. We'd like to thank you very much for joining us today, and we're here to help. None of us make any money unless we make loans. So let's work together and do a lot of that. I appreciate it.
All right. Well, with that, thank you everyone for joining us today, and have a wonderful St. Patrick's Day.